What if I told you that gathering the right facts and understanding your financial agreement could save you thousands on your mortgage after a divorce? Separation and divorce are already emotionally exhausting, but making uninformed decisions about your home could add unnecessary financial stress. Today, we're going to break down the key mortgage considerations that can help you or someone you know make the best possible decision during this transition. Hello, I'm David Zai, your trusted mortgage expert. Welcome back to my channel, and thank you for joining today's session on assisting divorce and separated clients. Whether you've personally gone through a separation, know someone who has, or work in real estate and finance, you understand how challenging this process can be. The last thing anyone needs during this time is added stress about housing and finances. That's why today, my goal is to bring clarity to this life-changing event and present real solutions that can make all the difference. One of the first major concerns during a divorce is what to do with marital property. Should you keep it and refinance the loan into one spouse's name, sell the property and split the proceeds, or rent it out as an investment property? These decisions shouldn't be made emotionally or hastily. A well thought out plan can prevent financial mistakes that could affect you for years to come. That's where having a strong support system, a knowledgeable real estate agent, and a skilled wholesale mortgage broker becomes invaluable. Together, they can help assess your options, navigate mortgage financing, and find the best solutions for your unique situation. Going through a separation is overwhelming and emotions can cloud financial judgments. This is why working with a professional who provides both empathy and strategic financial guidance is so important. The right mortgage and real estate professionals act as an advocate, ensuring that you don't make costly decisions in the heat of the moment. We're here to help you guide through these transitions, presenting all options so you can make informed choices that protect your financial future. What's next, you may ask? Over the course of this video today, we're going to talk about how to qualify for a mortgage post-divorce, what a lender looks for when refinancing after separation, the impacts of divorce agreements on home loans, and financial strategies to ensure stability after a split. If you or someone you know is going through a divorce and has questions about their mortgage options, stay tuned. This information will make all the difference in securing a stable financial future. And if you'd like to talk one-on-one about your specific situation, click the link below to schedule a consultation with me and my team. I'm here to assist and help you find the best solution that fits your needs. So let's dive in. As we've already mentioned, divorced and separated clients face a lot of unique issues, and these issues can be quite painful to talk about and resolve. This is where experience counts. Let's take a look at some of the points to discuss. The first thing that we want to talk about is the division of assets. If there are assets like a home, rentals, investment properties, 401k accounts, savings, or even personal property, the parties will have to agree who gets what. Assets are great to have, but each type of asset is viewed differently in lending. The division of liabilities is also very important. Most married couples have shared liabilities. How those liabilities are handled during the divorce and who is ultimately responsible for the liabilities can result in excellent outcomes and catastrophic outcomes, like credit issues. I'll talk more about this issue specifically a little later in our program today. Child support and alimony payments are the next thing. Here's something that you may not know. As a lender, I'm not permitted to ask clients if they receive child support or alimony payments. I'm only allowed to ask if there are any types of income that the clients would like to have considered for the repayment of the loan. Specifically, Equal Credit Opportunity Act prevents us from asking specifically about alimony or child support because of discrimination concerns around marital status. If the client chooses to disclose this income to us, we can work with them regarding the guidelines required by the lender for receipt of those payments or payments of that support. On the other hand, if the client is paying child support or alimony, I am permitted to ask that, as it is a liability that must be considered. Disposition of marital homes and associated debts is really important. Marital homes and how it is titled along with who is on the note are details that can make or break getting a new mortgage. As much as we all hope for the best out of a bad situation, sometimes that just doesn't happen. Arguments, hurt feelings, revenge, or lack of income get in the way and cause extenuating circumstances or credit issues. I'll go into greater detail on this subject later in this video. How the client works through and is guided through these unique issues will either result in a situation where someone is or cannot get financing for what they want to do. Let's take some of the stress out of this situation and talk about the details clients should think through. The first place to start when assisting a client is gathering the facts. Whether decisions have already been made or whether a client is seeking options for decisions they are contemplating, this fact gathering step is critical to their success. Sometimes assumptions are made that if the couple living in a home together, that they both have to be on the title and the note. Those loan officers who have not been in the industry long enough will not know how to handle these situations, and we tend to see all sorts of variations in this area, such as one person is on the note and both are on the title, or one spouse is on the note and title and the other spouse is not. Who is living in the home, how long they've been living there, and who is on the note and title can make or break a a refinance if one party wants to stay in the home. Or in case of a veteran client, if a veteran quit claims from the property, their eligibility is still being tied up on that property, which means they cannot use that part of the VA financing on another home. As you can see, it gets complex depending on that person's situation. Do they have legal or financial counsel? Clearly, we are not legal or tax consultants and don't want to be put in that position. However, if they have legal or tax consultants, I would like to work with them as the loan officer to help the client structure a mortgage loan that meets their desired outcome. Has your client or have you thought about whether or not you want to keep the house, sell it, or buy something else? It may be easy to decide that between the parties, but if it is not structured in a way that can result in both parties getting their own financing, it can result in bigger issues for them. If the couple has minor children and discloses child support, then a lender will consider the child's age and longevity of the child support to use this as income. Generally, lenders look for child support to continue for 3 or more years. If alimony income is being disclosed to a lender, then the lender will need to work with the client about using this income or consider it a debt. When alimony or child support liability is disclosed, lenders will consider this to help the client pick the right program based on their needs, as there are variations in loan programs as to how the lender handles these types of debts and debt-to-income ratio. Lenders will also look at the types of agreements in place. Again, I cannot stress enough, it's important to talk with your lender before making some of the decisions, as many people are so disappointed that they cannot buy their own place because they did not think through the details. One of the most important details in a divorce or separation is whether or not there is a legal agreement in place. Lenders like agreements that are formal, written, and court-ordered. Those agreements are the only way lenders can demonstrate good risk decisions and borrowers' stability regarding assets, income, and liabilities to get approved for a loan. If agreements are not formalized or court-ordered, then the lender may not be able to proceed without that. It really depends on the client's situation. For instance, if a formal agreement exists that says spouse A is responsible for the house payment, even though spouse B is still in the note, the lender does not have to count the payment against spouse B because the agreement is court-ordered. However, if it is not court-ordered, the lender must count the house payment against spouse B. Unfortunately, there are not many people who can qualify with 2 mortgage payments. A client does not need to disclose alimony or child support, and as stated earlier, as a lender, we cannot ask if the applicant receives alimony or child support. We can ask them if they receive any other types of income that they would like to consider for the repayment of the loan. However, we can ask if the applicant is required to pay alimony or child support, as this would be considered a liability that needs to be considered. If the client discloses that they receive alimony or child support, the lender may be able to use this income. However, alimony and child support income are treated differently. A lender also considers the longevity of the income and how long it has been received. Since there are guideline variations in this area, one program may work better than the other. For instance, if I can only show that I have received for 3 months of child support or alimony, then my only options are FHA and VA. However, if I have received alimony or child support for 6 months or more, then my options open up to conventional loan options as well. Or if the court order agreement states that payments are voluntary, then this income could not be used on a conventional loan and only on an FHA loan if I have a 12-month history of receipt. Lenders must also document the receipt of income, which can be tricky if a client is not counseled properly before they consider applying for a loan. I've seen many circumstances where the payments are paid in cash or partially paid because one spouse deducted an expense or is simply sporadic in payments. The best counsel is to make the client aware of how lenders document receipt of payment to be sure that we can show consistent amounts on the applicant's bank statement. Now, lenders will also treat alimony income and child support income differently. Alimony is considered under IRS rules, therefore it is taxable. Child support is not taxable, and because lenders base their qualifying ratios on gross income, they need to adjust the income to a gross income that is what it may look like if it were taxed. To do this, they may have to add 15 to 25% to the client's income to gross it up. It really depends on the program, but that little bit of income can mean the difference between an approved file or a lower rate for you. Next, let's take a look at your liabilities. This usually is pretty easy to consider when you're single or married. However, divorced or separated clients may have commingled liabilities. How many months are left? One common question we receive on divorced clients who have been divorced for a while is whether or not we need to count a liability such as child support or alimony when there are fewer than 10 months left. For the most part, lenders will still count this debt. However, some programs consider the asset or impact of the debt. So it is important to always ask before assuming. Voluntary versus mandated payments. Voluntary payments are where the applicant has no legal ties to the creditor, will not be counted by the lender. As an example, a former spouse agrees to pay off the credit card voluntarily, not court-ordered, and that person is not officially obligated to the creditor. Because this is voluntary and not a legal obligation by the divorce or separation agreement or the creditor, the lender will not count it against the person voluntarily paying the debt. The bottom line is that it is not mandatory and the person could technically stop paying it at any time. Lenders look at secured debt liabilities and non-secured debt liabilities differently. We generally break these down into contingent liabilities or liabilities/debts paid by others. When a borrower has outstanding debt that was assigned to another party by court order, such as under the divorce decree or separation agreement, and the creditor does not release the borrower from liability, the borrower has a contingent liability. The lender is not required to count the contingent liability as part of the borrower's recurring monthly debt obligation. The best example of this is a housing payment. Once again, how this is structured is important to the type of loan a borrower can obtain. For instance, Fannie Mae does not require that the person was removed from the title, but Freddie Mac does. Now, while that may not seem like a big deal, there may be another file issue that requires the use of one of those programs over the other, which may complicate the loan approval. Again, this is another reason why lenders' counsel is so helpful to both the spouses as they move in different directions that they would like to go. Now, let's move on to debts paid by other. When a debt is not mortgage related, such as a credit card, even though another party may still be obligated under the agreement, the lender will still count that debt until they can show that someone else has paid it for the last 12 months. Let's now talk about quitclaims. Be warned that simply quitclaiming a person from the property does not eliminate the liability. So let's talk before you advise on this. You can probably imagine that credit issues can arise with the turmoil of a separation or divorce. It may be that the primary wage earner decides to stop making house payments and left the house, or that two residences cause financial stress. Lots of things can happen during this time. This is what lenders call life events or extenuating circumstances. Basically, it means that a blip happened in your credit history that is not an indicator of your credit history before the event or an indicator of your credit history after the event. Depending on the circumstance and the loan program, a lender may need to approve the loan manually, or they may need to get a loan approved through their automated underwriting system. That may sound like no big deal, but it can be. For instance, lenders may have less risk if a loan is approved through the automated underwriting because it means that the investor will take the loan. However, if a loan has to be manually underwritten, this can mean more risk to the lender. If the lender reviews the file manually, they look at whether or not the credit problems just occurred during the divorce. Has the person reestablished their credit after that life event, and are they now paying their things on time? Life is not perfect, and lenders know that. While this situation requires finesse, there's always a way to work with temporary life events. So don't lose hope and get the facts before you make a decision. The last important point regarding this subject is the difference between conventional loans versus government loans. While FHA and VA do not consider extenuating circumstances, and Fannie Mae and Freddie do, it doesn't mean that you should apply for conventional financing. Even though FHA, as an example, does not consider extenuating circumstances, they are a little easier to deal with on credit score issues and derogatory wait periods. This is another reason why an educated lender needs to assist clients so they don't get rejected when another loan type is available. Before we finish today, let's take a look at some of the common situations we run into. If an applicant cannot document 6 months or more of alimony or child support and they need that income to qualify, FHA and VA are their options. If the child support is voluntary and the client needs that income to qualify, only FHA will take that loan with documented receipts of income. If the client needs to gross up the child support income and needs every cent they can get in income, then Fannie and Freddie or conventional financing offers the most generous gross up amount. If the title has not been transferred out of the client's name, but the other spouse must pay the house payment based on the agreement, then Freddie Mac is the best solution. Fannie Mae may be the way to go if there are extenuating circumstances, as their automated underwriting system will accept extenuating circumstances. If approved, the client will not have to go through a manual underwriting, which could increase their rate. Take control of your financial future. Divorce is one of the most challenging transitions in life, but your financial future doesn't have to suffer because of it. Making the right decisions about your home and mortgage now can save you stress, money, and uncertainty down the road. The key is having the right information and a trusted advisor to guide you. If today's video helped you understand your options better, but you still have questions about refinancing, buying a new home, or handling your mortgage after divorce, I'd love to help. Click the link below to schedule a one-on-one consultation with me and my team. I'm here to walk you through the best strategies for your unique situation. And if you found this video helpful, don't keep it to yourself. Like, subscribe, and share it with someone who might need it, whether it's a friend, family member, or a colleague going through separation. Knowledge is power, and the right advice can make all the difference. Thank you for watching, and I'll see you in the next video.